broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, welcome to our webinar, Let's Learn Futures. So this webinar is sponsored by Bursa Malaysia and is managed by LifeChamp. And the topic for today will be psychology in trading in the futures market. Before we begin, if you can hear me and if you can see the screen, can you please click raise the hand button? Okay, I'm seeing a lot of hands being raised. So you can see me and you can you can hear me and you can see my screen. Okay. So for the disclaimer, whatever that is shared in this webinar is purely educational. We will not be responsible for any stocks that you decide to buy or sell, as this webinar is purely for education purposes. And these are our next webinars, the webinars that we have planned for until end of the year, until November. And the next webinar will be on the 12th of September. So now I will introduce Miss Pauline. Pauline is a certified financial planner and she has been in the trading industry for more than 20 years. So without further ado, let me hand it over to you, Pauline. Thanks for having this webinar with us today. So I'll just make you presenter.
Okay. Hi. So I need to share the show the screen, right?
Yeah.
Okay. So is it showing my screen now?
Yes, it's showing your screen now.
Okay. Hi everyone. My name is Pauline Young. It's good to be back again. So for the previous session, I talked about fundamental analysis and also talk about technical analysis. So today I would like to talk about the psychology of trading. Now, a lot of people they are either separating into like either you are fundamental analysis or you are the technical analysis people. But there are people whereby they trade in the futures market. However, they may not look at any fundamental or any technical. They use by the psychology. Okay, the psychology of trading, it is something like a in one word, it's more like a probabilistic mind. You must have a probabilistic mind. You must be able to calculate the probability inside your mind. So today the session basically it will be two parts. The first part will be about what are the mental bias of trading, and then what are the indicators and the sentiments and the market news. That means we talk about the factors of this trading psychology. And then the second half of this webinar will look into the application, how we're going to use certain technical indicators to look at the sentiments of the market. Okay, so let's start. Oh, sorry. My screen. Okay, let me see where's my screen. Okay, here. Trading psychology. So if you have heard the word, there's a sentence it's called the being comfortable with the uncomfortable. So that means when you are trading, right, most of the time you feel at the back of your mind, you feel very uncomfortable sometimes because you're under tremendously very stressful state of your mindset. Because for example, when you are trading a long position, probably you are actually trading at the time whereby people are very bearish, and then you take a long position, you buy in when people are bearish. So that means you are very uncomfortable. Your mind is keep on questioning yourself whether you are doing the right thing or not. Okay, so that kind of psychological state of mind that you are involved. So a lot of traders, they say that if you are used to this mindset, that means you are used to this being uncomfortable all the time, that then you are considered quite a a trader, because you are getting used to that kind of a mindset. Because for certain people, they cannot take that kind of a stress. Okay, of course, the risk management is also very important, because if you have the risk management in place, you may able to reduce your risk, okay, when you're trading. So today I will look into the psychology of trading. So what is trading psychology? So trading psychology refers to the emotions and mental state that help to dictate success or failure in trading securities. So you are looking at your emotional and your mental state of your mind. So trading psychology represents various aspects of an individual's character and behaviors that influence their trading actions. Okay, so there are a lot of decision you need to make, and a lot of emotion involved as well. So basically, there are a lot of mental biases. So I just picked 5 that most commonly that we have, that we see as a bias. That means like mental mistakes. So there are 5 of them. So the first one is the gambler fallacy. So the gambler fallacy, also known as the Monte Carlo fallacy, whereby you're looking at the number of chances. So for example, oh, I have 10 chances of, I already won 10 times, so probably the next time I will lose. So the chances of losing the next time is higher. So you are saying that if this occurrence is very often, okay, so the frequency increase, so the chances of the opposite will be happening soon. So this is not true when you are trading, because you need to treat each trade individually. The next trade will not have any relationship with your previous trade. So you must see them as a separate. You cannot say that the first 3 win, then the next one you have to lose. No, it's not like that. Okay, so you have to look at each trade individually. And then the next one is recency bias. So recency bias, for example, you lose money in 3 recent pullback trades. So that means you are looking at the recent experience. You look at the recent experience, and then you will tend to jump into conclusion, okay, this is it. Okay, based on this recent experience, I had concluded that this is not a good strategy. In fact, we should look at a longer time frame. That means we should, instead of looking at the recent trade, we have to look at the more on a bigger, wider time frame. For the past few months, or for the past 1 year kind of data, if you do this kind of strategy, what is the chances of winning and what is the chances of losing a trade? So you don't just based on your conclusion based on the last few trades. Okay, so you have to expand your period. Okay, then the next one is called confirmation bias. So we do not like people to tell us that our what we think is wrong. So that is kind of like we like to listen to people that agree with us. So this is a very common kind of a mental for any individual. Okay, so if let's say you believe that a particular stock, for example, public bank, you think that, oh, public bank is very good, and then another person says something bad about that public bank is no good and things like that, then you will not take his word, and then you just believe in what you say, you think. Okay, so this is known as a confirmation bias. So if another person agree with you that public bank is good, then you were even more sure that public bank is very good. So we tend to place more weight on the information that confirms our position. Okay, so when more and more people agree with you, you will think that, okay, my reasonable thinking, my rational, like my choice of this stock is the correct one. But hence, this is not the right way. You should be more objective. So when you think everything is confirming your market, you have to think again. Try to think about the opposite. Okay, if everybody said now it's bearish, but then how about you think opposite? What if there could be a bull coming up? Okay, so you have to think objectively. Think for the opposite position as well. Okay, and try to look for reasons against taking this original position. Try to think of the alternative. Then the next one is herd mentality. So this one is very common kind of a mental bias. We always like to follow the trend. But however, this herd mentality, I'm not saying that it is completely wrong or it is completely correct. What I'm saying that herd mentality, sometimes you need to, it is true when you are following a trend, okay? When the trend is there and then everybody is moving the same way, you follow, and then you are the trend follower, okay? So be it. However, when up to a point, the trend is going to reverse, and then when everybody still believe in that, then maybe you need to think that you shouldn't be following this trend for, you know, for a certain reason. So that means you must be able to think objectively. You cannot always follow the trend, okay? Even though when you are following the trend, you have to always keep questioning yourself whether this is the right way. Is there an alternative? What if anything happened? What if the reverse is going to happen? So you always have this kind of a second guess about your decision. So this is what I have been doing. That means when I'm trading or when I'm investing, I always have this second thought that, okay, what if this thing doesn't go according to my way? Then I will have a contingency. And then my contingency for trading will be my stop loss. I will have to cut loss at certain price. Before entering, I will have to have a certain stop loss price in mind that if this thing didn't happen, I will just have to go. Okay, very simple. You don't have to attach any emotion on it. Then loss aversion. Loss aversion is the meaning of loss aversion. That means you are scared of losing money. Okay, you don't want to be. When you see that you have a paper loss, you feel that if I were to realize the loss, if I were to cut loss, it becomes a realized loss, then it is more painful to you. You rather look at it as a paper loss. So, and then this paper loss is getting bigger and bigger, and then eventually you still have to face it. So therefore, when you have this mental bias of loss aversion, you were scared of cutting losses. When even in your stocks or in your futures or in your trading, you are scared of losing money. So this is a very common human mindset. So in order, we all know that we have this problem. So in order for us to overcome this, so sometimes we need to understand that for trading, you have to cut loss. Cut loss is kind of like a normal thing. There is a trader whereby he said that when people want to be a trader, in order to train you to be a good trader, the first thing you need to do is to learn how to cut loss. Okay, so that's a saying that if you want to be a good trader, maybe the first thing you need to learn is that how to cut loss consistently. Okay, so because as a trader, cutting loss is your cost of doing business. Losses are merely a cost of doing business. Okay, so we have to treat it as your cost of doing your trade, and then this trading is a business for you. Okay, so after talking about the 5 types of mental bias, now we look at market sentiments. Okay, so sometimes we always heard people say, oh, now the market sentiment is no good, and we have a bullish sentiment, and then we have a bearish sentiment. So what are they? Okay, so these kind of sentiments are always influenced by the market news. So sometimes we see that a lot of positive news in the newspaper, and then we have a bullish view about the stock market. And then sometimes when we have a lot of negative news, and then that's a bearish view about the stock market. But however, do you know that when you see that the whole of the newspaper is about bearish news, like 80 or 90% of the news are all bearish news, right? Probably that is the bottom of the bearish cycle. Okay, so it's always like that when everybody is so bearish that you cannot think of buying any equity, and that probably is the turning point already. It will start to turn. Okay, market sentiment indicators. So these are the market sentiment indicators that are very common that you will have to look. A lot of time we as an investor or a trader, every morning, the first thing you wake up, you look at your overnight S&P 500 index, the Dow Jones Industrial Index, and then you look at the NASDAQ. These are the 3 things that you have to look at the US market. Then you look at the maybe Donald Trump's Twitter, because you want to see what's his tweet, because that may influence the stock market. And then you will also want to see the European market. And then when it's 8 o'clock, you want to see the Asian early market, the Nikkei, and also the Hang Seng. Okay, then come our Malaysia, 9 o'clock. Okay, so all these are the indices that you need to look out before you trade, because this will influence that day's sentiment, whether you have a bullish sentiments or a bearish sentiments. Okay, and then the volatility index, which is the VIX, is also important, because this VIX index, if you were to Google, you can see that the VIX index talk about the volatility of the market. So when people are very bearish, when we are very pessimistic, then the VIX index will shut up. Okay, so when people are very bullish or you are optimistic, then this VIX index will reduce. Okay, so now this VIX index, I would suppose that because of the Dow Jones have been performing quite well for the past few days, the VIX index is slowly reducing. Then you have an advance over the decline. Okay, the number of stocks that advance over the number of stocks that decline for that particular day. So this one usually we see from here. I refer to the Bursa station. So this is our KLCI index for today, 1602, and today plus 7 points. And we have this losers and gainers. Okay, the gainers is 300 over, losers also 395. So losers is a bit slightly more than the gainer, but they are around 50-50. So that means the sentiment has already improved, not that bad. That means 50-50 now. Okay, because as the US market is improving, our sentiments here also improve. Okay, then continue. 52 weeks high, 52 weeks low. This one you should know, right? Because according to the equities, this particular stock, what is within the past 52 weeks or 1 year, what is the higher high or what is the year low? Okay, so if your price currently is near the 52 weeks low, that means the sentiment is rather bearish. For example, the banking stocks is currently near the or already in the 52 weeks low. Okay, then another one is the put call ratio, the put number of put over the number of call. Okay, so this one, if you can see, the put is the above divided by the call. So if it is less than 1, it means bullish. Okay, if it is more than 1, that means more put than the call, because the put is up and then the call is below the denominator. So when you have greater than 1, it means very bearish. So currently our equity put call ratio is around 0.7 or 0.65. Okay, it has gone down. If it's equal to 1 or above 1, it is bearish. So right now the sentiment not so bearish. Okay, it has become rather bullish because of the US market. And this one is referring to the US market, not our Malaysian one, because if you were to Google, you have to Google CBOE, okay, Chicago Board of Exchange, CBOE, and then they can give you the put call ratios and then different sentiments indicators. Okay. Now this one is a sample that you can see from our CNBC website. So this website, I always look at it because it is very easy to look at one glance. If you want to click the European market index, you can click the EU, and then you can see at one glance what the FTSE, the Germany and the France and all these markets are doing. Okay, and when you click the Asian tab, then you can see all the Asian markets are doing. Okay, and then when you click the US, you can see all the Dow Jones, S&P, and Nasdaq. All this you can see. So it is very convenient at one glance. Okay, so and the VIX you can see is always opposite. When this is down, the VIX will go up. Okay, so VIX and the equity is always opposite. All right. Okay. Sentiment, gainers over losers. So this is what I showed you just now, right? The gainers, and if it's a very bearish month or a bearish day, you'll see a lot of losers. That means the number of shares that is down. That means the price has gone down is a lot more than the number of shares that the price has gone up. Okay, so the losers outnumber the gainers. So this is in a very bearish environment. However, if you look at it, although it is bearish, minus 12 points for our KLCI index, but the percentage, it is still within 1%. So usually if it's within 1%, I wouldn't say that it's too bearish. Usually when the price increase or reduce more than 1%, then I would think that that day is very significant. Okay, it will mean something. Okay, so if it's below 1%, I would think that it's just normal fluctuation. Okay, however, it also depends on the market, because our KLCI index is very low volatility. So even sometimes a 12% kind of a move is considered a big move. Okay, so it depends on the market, depends on the stock itself. All right. Okay. Now, this one, I show you the 52 weeks high and 52 and the 4 weeks range. So you can see that in the past 4 weeks, what is the price range, and then for the 52 weeks, what's the range? Okay, so over here, if it's 8.65, and then you look at it, it is near the 4-week low, and it is also near the 52-week low. So you can see that the sentiment for this particular stock is very bearish. Okay, and so this one is the CBOE, Chicago Board of Exchange Equity Put Call Ratio. So for this particular date, August 1st, it was 0.75, but today I look at it, it was 0.65 or something. Okay, it has gone down, and this is the chart. Okay, the put call ratio have the chart. Okay, trade on news, non-farm payrolls. There are certain traders. There are some people, some traders, they only trade on this non-farm payroll, and by all means, because as a trader, you just trade whatever news that you find it most comfortable with. That means you are very comfortable in trading non-farm payroll. By all means, you just trade with this piece of information. If you are very comfortable with trading the trend line or the breakout, you just trade with what you are consistent or what you are comfortable with. Very often, the one that you always repeat winning the chances, that means that strategy is suits you more, and then you can keep on repeating your winning chances. Okay, so but as a beginner, you need to explore a few, and then once you explore a few, then somehow you will see that, okay, certain strategy I make more money, or the chances of winning is higher, so I will tend to stick to that old strategies. Okay, however, as the time evolve, right, because the whole market is very dynamic, so sometimes over a period of time this strategy may not work, and then you have to implement your strategy again. So but as long as it is working, you can keep on using that strategy. That's what I want to say. Okay, be comfortable with what strategy you are using, and then you just use that strategy. So there are people only trade the non-farm payroll. So what is non-farm payroll? So this non-farm payroll is like a job data. So the word non-farm meaning that you are not a farmer. So you are the executives, you are professionals, you are workers. That means you are not working in the farm. Okay, so 80%, over here you can see 80% of the US workforce is the non-farm payroll. So where can we get this data? We can get this data from the trading economics. Okay, trading economics, and then you can look at this data. So over here you can see the trend of the US non-farm payroll every month, month by month. Okay, so this is the trend. So if it's below 100,000, it's actually quite alarming. Okay, these 2 months are below 100. That means that 2 months probably the Dow Jones or the equity market will be quite bearish. Okay. Okay. Then these are the other, besides the non-farm payroll, you also have the Fed interest rate, whereby currently at this moment, the Donald Trump is always talking about the interest rate, because he is trying to pressure the federal power to reduce the interest rate. Okay, so we will see that most likely there will be another chance of lowering the interest rate towards the end. So the chances is high. So when the interest rate is low, so basically the reason why they want to reduce interest rate is to boost the economy. Okay, so and then And this, when you have a lower interest rate, then the bond price will increase. So then when the bond price increase, then the bond yield will reduce. So all this will affect. That's why recently you have this inverted yield curve, and then everybody is nervous about this inverted yield curve, because they think that when the long-term 30-year-old interest rate is the yield is higher than the short-term, that means people are actually putting more money into the longer term, which is not logical, because usually the yield is supposed to be, you know, upward rather than inverted. So that's why a lot of people, they think that could be the recession is coming, because of the people rather to put in the long term rather than short term. Okay, so recession could be coming. But according to the statistic, they said that it's within 22, on average, it's about 22 months for the US economy in order to have another recession. Okay, so the job data is the non-farm payroll, the oil prices, the GDP, export figures, the PMI. This one, purchasing manager index, is also very important, because this one, if it's above 50, that means the economy is expanding. The people are purchasing. The manager, the purchasing, the factories, the manufacturers, they are purchasing their order, they're still continuing to produce. Okay, this purchase manager index is referring to the factories, whereby the suppliers, they are buying the raw materials to produce more. Okay, so if it's above 50, that means they produce more, that means the economy is growing. If it's below 50, it means what? They cut down on their purchasing, and the economy is producing less, and then the economy is actually contracting. Okay, so that's why the PMI index is also very important, especially for our Malaysia regional countries. Okay, we can see that the weakness about Malaysia currently is this PMI, because it has been, I think for the past few months, 5 months, it has been below 50 point for the past 5 months. Okay, and corporate news, dividend, earnings announcement, all these market news will influence the sentiment of the market. Okay, now how to apply the technical indicators to overcome the mental bias. So a lot of time people are very you feel very helpless, because the news, they are all over the newspaper talking about bullish news, and then very rosy kind of economic data. Suddenly, how come there's a stock market crash? Okay, out of nothing. Then you have no reason why this thing will happen. Is there any technical indicator or any sign that we can see, you know, from the software or whatever, that we can tell that, oh, there will be the sentiments is changing? So now in this second half of the session, I'm going to talk about the application of these indicators and how to utilize them. Okay, so at one glance, you see that we have these technical indicators. So we have RSI, stochastic. These are quite common indicators. Average true range, ATR, MACD, MACD, MACD. On balance, volume over the, and also the open interest. Okay, so out of these 5, right, which one you think, all these are influence the sentiments? Okay, the looking at the sentiments of the market. And however, out of these 5, right, each of them have their niche. Okay, their niche in identify what kind of sentiment, because under the sentiment you have this big blanket of sentiments, what kind of bullish, bearish, right? But with this big over sentiment, right, you also have a very different category. Okay, maybe you have a over bullish, overbought, and oversold. Okay, over bullish or over bearish kind of a sentiment. Or you have another sentiment is that just or you have a bullish trend. You just want to know that whether this is a bullish trend or this is a bearish trend. You just know the general thing. Or let's say you want to know, okay, the volatility. I want to know what kind of a volatility is it for this particular stock or this market, the volatility. Or you want to know whether the smart money is coming in, okay, and then whether this sentiment or this bullishness is going to continue. or you want to know whether people are still interested in this particular market. So out of these 5, right, each one of them, they have their own niche way to telling you what kind of sentiment is it. Okay, so we start from the first one. So the first one, I'm sure all of you are very familiar with this, which is the RSI and stochastic. So if I were to ask you, what does this tell you? What kind of sentiment it tells you? So I'm sure all of you will have to give me the same answer, which is overbought and oversold, right? This one is overbought and oversold. So you can later I will explain. Okay, let me go to this one first. Okay, so this is the RSI. Okay, RSI. We are looking at the FKLI for the RSI. So you can see that this over here, the first one is RSI, the second one is a stochastic. Over here, I changed the parameter a bit to 80 and 20, so that I want this indicator not touching the band so easily. So I put it 80 and 20 instead of 30 and 70. So you can see that it didn't touch until, you know, quite some time. Okay, so then this one touch here, touch. Okay, so every time when it touches this the lower band, we call it bearish, oversold. Okay, oversold. And then maybe when it is oversold, is it time for you to buy some? Yes. Okay, so this one is telling you that this market or this particular stock is oversold. So then if you are looking at sentiment, whether this market is oversold, you look at this indicator, because sometimes the price keep dropping and it drop and drop and drop, but you do not know when is the best time to enter. So maybe with indicator, this one is good. But however, I still prefer the trend line, because if you follow my previous webinar, when I talk about the technical analysis, the very first thing that gives you the sentiment is actually the trend line. Okay. However, if let's say you do not want, or you do not know how to use a trend line, you want to rely on an indicator. This is the indicator. Okay. The RSI and the stochastic will be the indicators that tell you overbought and oversold. But if you are good in your trend line, you just draw the trend line straight away. You know whether when is the trend is changing. Okay, it's very straightforward. I've done that for you. So if I were to draw again, okay, so maybe I will draw again. This one is a trend line, and then if you cut the trend line, then the trend is reversing. Okay, so then you see it is going down. Then this one is a downtrend, and then if it break above this trend line, and then it will be going up. So it is very clear. Okay, it is very clear. Trend line, and then trend line. Okay, very clear. So drawing trend line is very clear to see whether the trend is reversing. However, if let's say you need to rely on indicators, these are the indicators. Okay, then the second one is called the average true range, ATR. So I will usually look at this average true range is to give me the volatility sentiment. That means I want to know for this particular market or for this particular stock, how large the price movement will be. Okay, so the price every day, you know, the price will go up and down, right? It will go up and down. However, if I were to ask you, what is the Maybank day high and day low? What is the average? Okay, for Maybank day high or day low? What is the highest, lowest, the maximum price that it will move? Okay, is it 20 cents, 10 cents, 15 cents? What is the average? So if you want to know the average of this, the average price volatility, you refer to this average true range. So for example, the Maybank that I told you, if it's 8.55, and then maybe end of the day it become 8.57 or 8.56. That means the day change of the day, that means within one day, the price only changed by 2 cents or 3 cents. Okay, so that means the volatility is like 2 or 3 cents, is very low. However, if let's say the share price of Maybank change from 8.55 to 8.65, and then sometimes 8.75 within a day, then we can see that the average volatility for this Maybank share is 20 cents. 10 cents. Okay, so the price movement, okay, for that day is called the volatility. Okay, and we can see this as a support and resistance as well. So for example, especially the day trader, because you are actually buying for the you buy in and then you want to sell, right? But when you want to sell, you do not know when to sell. Then you have to look back at the past few 10 days or 5 days. What is the day high and the day low, and what is the volatility? Like for example, like one day the price change is like 50 cents. Of course, you can put your target higher to 40 cents, then maybe you can sell your price and then you can take profit. However, if that particular stock, the volatility is very low, maybe 10 cents or 5 cents or even lower, then when you want to do a day trade, you cannot expect the price will go like 10 cents or 20 cents. The price most likely will be a few cents, and then probably a few cents that you have to cut loss already. You have to take profit already. Okay, so this average true range, some people would treat it as a support and resistance as well. You can treat it as a stop loss strategy as well. The usage is very wide, but basically it's about the volatility. So let me show you the diagram. So this one is the average true range, whereby this is how it's calculated. Basically, there are a few ways of calculating. So I just choose one because I don't want to confuse you. So basically, it's the day high minus the day low. Okay, and then if you're looking at the ATR of 14, which is the past 14 days, then you have to sum of the 14 days day high, day low, minus day low, like 20 cents, 10 cents, 5 cents, 10 cents, 15 cents for 14 days, right? Divided by the number of days, 14. Okay, so you get the average range of the price range of this particular stock or particular market. Okay, so how do you use it? So it's very simple. You look at this volatility. The ATR is at the here. Okay. Great. Okay, you can see that this at the bottom of this indicator, whereby we have sorry, the mouse, whereby we have this line. Okay, you see the line. Okay, you see the line towards the end there. Okay, so this line tells you the price. Okay, this line tells you the price. I need a highlighter. Okay, this line tells you the average true range. That means the volatility, like each day, what is the average price movement? Is it 10 cents, 20 cents every day? Each bar will have each indicator. So over here, you can see that if this ATR is rising, right, that means that the volatility is increasing. So it could be 10 cents, 20 cents, 50 cents, or even more. So as the price movement is bigger, the ATR is rising. This is based on the past 14 days. So the average will pull up the average. So this ATR will increase. Okay. So usually when you see that this ATR is increased, this is where the largest price action is. Okay. When you see the ATR is rising, that means where the price action is very huge. Okay, so that's why the ATR is rising. And then this one also very large price action, so that's why it is maintaining at a very high position until after a big drop, and then you've got like a ball when you have a bounce on the floor, and then you bounce up and then bounce, then the volatility becomes lesser and lesser and lesser. So as you're getting lesser and lesser volatility, right, then this ATR, that means every day the average, on average, the price change is getting smaller. Maybe beginning you have a 50 cents of a price change, or maybe 50 cents of a price drop. Then the next day 30 cents drop. Then the next day 20 cents of volatility. Then when it comes to the price stabilized already, then maybe the price becomes stabilized, and then it become like maybe a few cents of a change every day, each day. So become lesser and lesser volatility. Okay, so then this one become lower and lower and lower. Now the trick here is every time, right, when you see that the volatility become low, and then when it turn up again, it is where the price action increase again. So that's how people there are different ways of trading this ATR. Some people, they look at it as in when it is because if you know the price action, sometimes the price action is like you have a big fall or a big rise. After the big fall or big rise, then the subsequent price action will be lesser volatility, and then the lesser volatility, and then up to a point whereby the volatility is low enough, and then suddenly there's another price action. Okay, so if you know the Bollinger Band, it is something like the Bollinger Band, whereby you have a constriction whereby the volatility reduced, and then suddenly you have an expansion because of the volatility increase. So this one ATR is when you look at the volatility, it's something like that. Okay, the price actually move from low volatility to high volatility, and then sometimes after the high volatility, then you come down to low volatility. So it's always like that. Okay, so therefore when people want to trade the ATR, they just look for the volatility. The volatility could be very bullish volatility or could be very bearish volatility. As long as it's a big jump or a big fall, right, it is considered high volatility. So if you come from this small volatility, and then when you increase, then it become high volatility. So this one is also another thing. When you increase, and then this is the price action for big fall. Okay, and then another one here over here, it is kind of stagnant, and then when it is breakout over here, when it increase, pick up the volatility here, and then you can see the price action also increase over here. There's a big bar there. So this is average true range, whereby you look at the sentiment as in terms of the volatility of the market. Okay, then the next one is the MACD. I used to like the MACD because I find that, oh, MACD with one single indicator, right, you can have the overbought and oversold, you have the bullish, you have the volatility, you have the momentum, you have all kinds of things in this one indicator. So, but now I'm more towards the trend line. I think the trend line will tell me everything. Okay, so this MACD, the formula for there's two lines over here. The blue line representing by the MACD line, whereby the calculation is 12-day EMA minus the 26-day EMA. So the blue line basically is this 12-day minus the 26-day. So you can even plot this 12-day and the 26-day over here, and then you can see how the reaction with this blue line. So basically, my point is, this MACD line tells you in general, okay, in general, whether it is bullish or bearish, okay, whether it is trending or non-trending. So basically, it's bullish or bearish. So over here, when you see the red line is the signal line. Signal line is the EMA 9 EMA of the MACD. So over here, we concentrate on the blue line first. So as long as you see the blue line, okay, the blue line is falling, right? Okay, as long as you see that the blue line, it represents this meaning. That means the 12-day EMA minus the 26-day EMA. So as long as you see the blue line is below, okay, below the zero line, it is negative. Okay, the blue line below the zero, this is a zero line. This center line is a zero line. So if, let's say, this MACD line, the blue line is below the zero line most of the time, like this one is below the line most of the time. It went up and then it come down again. So generally it is bearish. Okay, it is bearish for this particular market or particular stock. Okay, so that's one way of looking at the general bullishness or general bearishness. So I usually look at this MACD just looking at this line. However, if let's say you want to know the momentum, okay, the momentum. Remember in my previous webinar, I mentioned that the slope plays a very important. for example, you have a big jump, okay, then the slope of the trend line is very steep, is more than 45 degree, and then you have a slow upward moving on a 45 degree line. So the one maybe 55 degree, 60 degree compared to the 45 degree, the 60 degree line, the momentum is much stronger because it is a big steep jump. Okay, so therefore, if we were to translate over here, it will be the height of the histogram, the height of the histogram. So if you look at this, the bar, the height of the histogram is a long bar. Usually it's followed by a very steep price action. Okay, very steep price action. And then you see another one over here. Okay, a long bar also. Okay, then the price, the volume also increase. And then over here, there's a long bar over here, price drop. Okay, so usually when you see the momentum, you look at the histogram. Okay, the histogram of the MACD. So that's why with one indicator, you have the momentum, you have the general bullish or bearish line, and then you even have the overbought and oversold. You look at this overbought, oversold, overbought. Okay, so that's the good thing about MACD. It tells you a lot of things. However, I usually just look at the general bullishness or bearishness at one glance. Okay, because there are so many indicators. So if you were to focus too much, then it will cloud your mind. Then we look at the unbalanced volume. So basically, I look at this unbalanced volume as the demand and supply, because this one is where people say that it's where the smart money is. Okay, so you can see the calculation is whereby you use the up day volume minus the down day volume, because sometimes you have an up day, you have a down day. Okay, up day is represented by the green candlestick, a down day is represented by the red candlestick. So when you have an up day volume more than the down day volume, naturally it is bullish, right? And then when you have the down day volume more than the up day volume, it is bearish. That means more people are selling, okay, rather than buying. So over here, we can see that this is a unbalanced volume, OBV unbalanced volume is trending down. Trending down, then the price is going down. So trending up, the price is going up. Trending down, the price is trending down. So therefore, this unbalanced volume, right, I will look at it as a confirmation of the trend. Okay, a confirmation of the trend that this trend is still going down, or this trend is going up. Okay, it's very general. So I wouldn't use this as a entry signal or whatever. Some people may think that this OBV can be used as a reversal kind of entry, but usually I don't use this to trade. Okay, it's just give me a sentiment. Okay, all these indicators just give me a general sentiment. Okay, then the last one is this open interest, the volume and the open interest. This one talk about the volume. Like the volume is your day volume, and then your open interest is looking at the people holding the contract for more than 1 day. Okay, so I would think that this open interest is more towards the people's or the market participants' interest in this particular market, whether the market participants is interested or not. If let's say in bullish market and then your open interest also rising, that means people are very much interested in this market, and then they confirm that this is a rising trend. However, if it's a falling market while the open interest still rising, okay, so that means people are interested in this falling market. They want to take profit. I mean, they want to take part in it. So they also join the force of the selling trend. Okay, so we look at this open interest over here. So for our futures, right, we have the FKLI and the FCPO. I'm looking at these two charts. So FKLI, because it is a current month, so you can see that this open interest usually end of the month becomes zero, end of the month becomes zero, end of the month becomes zero, because every month we have to close the position, so no more open interest. So that's why for this open interest analysis, usually I wouldn't look at it as a buy or sell strategy. Okay, I will look at it as which contract for me to choose, because out of so many contracts with so many months, forward month, I will have to look at the open interest, see which contract has the highest or a good number of open interest for me to participate. I will look at it as in that, okay, not as a buying or selling strategy. And then another one is the FCPO, but for this FCPO, because it is on a forward month, okay, 2 months ahead, so that's why the open interest is not closing, it is continuous. Okay, it's not like the FKLI whereby you're looking at the current month and then it closes every month. But this one we are looking at the forward 2 months, so it is always continuing. Okay, so this one is the FCPO whereby you see the open interest. So in general, right, you can see that whenever the open interest come to a low point, and then usually that could be a possible reversal. Whenever the open interest come to a low point, it could be a possible reversal. And then another, when the open interest come to a low point, possible reversal as well. Okay, and this one usually I will look at it over here. Here, Busan Station again. You can see there's so many FCPO, different contract months. Okay, different contract month. Okay, you have so many different up to 2020. So and the open interests are all here. So you look at the OI over here, see which contract has the most, and you can see this one is actually, now it's August, so it has to be October. Okay, so October. November, now it's October, November. So because it's towards the end of the month already, so become November, okay, the 3rd month. Because when you look at this FCPO, when it comes to the final week of the month, end of the month, then people will tend to trade the 3rd month. So it becomes this November month has the highest open interest. Okay, then we go back to here. So over here, let me show you. So if you were to list out all the indicators over here at one glance, you can see that we have so many indicators, and then sometimes it will crowd your mind if you lay out too many indicators at one time. So you must be clear what kind of sentiment I want to know. I want to know overbought and oversold sentiment. Okay, I look into the RSI and stochastic. Okay, if let's say I want to look at the whether the trending, whether it is a bullish trend or a bearish trend, whether the trend is confirmed or not, I look at the OBV. I don't have an OBV here. Okay, never mind. Or maybe I look at the MACD, the blue line. The MACD, if it's below zero line, okay, it is bearish. If it's above 0 line, it is bullish. Then it is bearish again, and then it is bullish. Okay, so this depends on what kind of sentiment you are looking for. Then you just extract the indicator to reconfirm or to find out the answer of your particular answer. Okay, you must have a question first, then you pick the indicator is to solve your answer. You don't without knowing what you want, and then you just simply look at the indicators, then you may be lost in the situation. Okay, you may feel lost because there are so many indicators. So you must be clear of what kind of sentiments you want first, then you pick up the indicators to search for to solve your answer. Okay. Okay, then we continue. So basically, the volume is the total number of shares traded. It is measured by the investor's emotional state. Okay, whether it's very simple. People buy is because they believe in this, and then believe in the trend, they just buy. Okay, whether it is uptrend or downtrend. You can have a bearish trend, but then the volume is very high. That means what? People is really thinking that it is really bearish and people are selling, eager to sell. So that's why the volume pile up. Okay, so therefore this volume is talking about the people's emotional state. Okay, and the open interest is a total number of contracts that remain open and held through at least one trading day. So if let's say you are a day trader, you trade within the day, right? You close your position. So your volume will not be included in the open interest because you close your position within that day already. Unless you hold your position more than one day, then your contract will become the open interest volume. Okay, so you can think of this open interest as in the someone is interested in the current trend or in this particular contract. Okay, and then they want to hold for a longer time. Okay, so now we come to this trading habits, because we know that we are all human. Okay, that's why sometimes people think that a lot of hedge fund, they are actually looking at the AI trading now, because if you listen to their interview, right? I listened recently to a few of their interview, and when they will interview what kind of a daily routine job they're doing when they go to the office, right? What do? They said that they will just have to monitor the machine, the automation of the trading, because they just want to see that whether the trade is according to what they want. Okay, it is already machine is doing the job of the hedge funds and not the human. So the trend is moving towards that, because machine can do better because they have no emotion. For human, we have too much of emotion. So that is why in the future, we will rely more and more on the machine trading, okay, or robots trading. So, but anyway, before we have that technology as a trader ourselves, we need to develop some good trading habits, okay? The first thing is that you must always have a trading plan. Okay, a trading plan is always important. Like I have a diary, I will write down all the trade that I trade. Okay, I traded. So this diary will keep track of my daily trades as well as my monthly, because I will also tabulate 1 month what is my win or what is my losses, and then I need to come up with a P&L for every month. So some people, they will do that for every week, but for me, I do every month. And then sometimes if I do not trade that particular month, I will not have any P&L. So it depends on whether you want to trade or not. So for me, I choose certain months to trade as well. Okay, because my time is very tight. I'm quite busy, so I do not have the time to sit down and then to do the day trading all the time. So I would choose certain months whereby I think that it is to my advantage, whereby I think that it is more volatile, then I will trade for that particular month. So that's how I trade. Okay, so I usually have a trading plan and then a trading diary, and so always do that. Okay, and then I will write down why I trade, and then I will have a cut loss point and then a target point, and then when I close a position, I will have to match back whether I did close the position at my target price or my stop loss. Sometimes I didn't, because of the human emotion. You just cut loss or you just close the position before reaching your target or your stop loss. So that's the reason why human, when it comes to trading, it is very emotional. And then number 2, keep a trading diary to understand. Okay, so this is what I do, and then you have to write down the reason behind each trade, why you want to pick that particular trade, what's the reason, what's the strategy. And then number 3, exercise on a regular basis to develop a disciplinary habit. So this one, if you to interview any good traders, right, usually they have this routine of exercising. Okay, because when you exercise regularly, it is kind of like a discipline. Okay, so and very often for a trader, you need to be disciplined. To cut loss or to reach certain target, you need to have a certain kind of a discipline. So therefore, by exercising, you can develop that kind of a disciplinary habit. Okay, and also stay focused to your trade. And the most important is to practice and practice and practice. Okay, so in summary, so today we have gone through the types of the mental bias, whereby we look at the different mental bias, such as the loss aversion, and then the gambler fallacy, and this kind of biases. And I'm not saying that this kind of biases is totally wrong, but sometimes it can be, if you to use it correctly, it can be to your advantage. Okay, like the herd mentality, if you use it correctly, it could be to your advantage. It's just that we need to establish a very objective kind of a mindset. Okay, we need to establish a very objective kind of a mindset. And then also we look at the different kind of market information, because sometimes when we are a trader, you have too much of information, the market information. There are too many from many different kind of sources. So you need to stay objective. Okay, you may read sometimes there are certain traders, they will ignore the news and then the information, market information. They will look at the technical chart as it is. Okay, they will not look at the news or whatever. They will think that the news are the noise. Okay, there are people are like that. Okay, however, for a general trader, basically the sentiment, like in the morning, you need to look at the indicators and the bullishness sentiments, bearish sentiments. All this you need to read first. Okay, so that you know that on that day whether it is a bullish market or it is a bearish sentiment, because it will it is the prerequisite, okay, for you to start a trade, to know the market condition first, okay, before you can trade. Then while you are trading, of course, there will be news. So that maybe during that time, you may ignore the news a bit. But then before that, you must establish whether it is a bullish or a bearish market. Okay. Then the most important is that your mindset, you must be able to have this probabilistic kind of a mind, because very often when you're looking at a certain trade, right, you must be able to count the probability. The way of calculating the probability is we can't teach you, because it's like it is very individual, whether you have it or you don't have it, because it's based on your experience. So that is why you need to practice very often, a lot, so that you gain that kind of experience, and then you can develop the kind of a probability mind to calculate whether this trade is good for you to go ahead or not to go ahead. Okay, so the mindset is very important. And also think very carefully about your psychology, state of mind when you enter a trade. What kind of psychology it is. Sometimes when you enter a trade, you feel very optimistic. You feel that, okay, the chances of winning is very high. I feel that I shall win. Okay, so after that trade, do you actually win after that trade because of this kind of a mentality that you feel very optimistic? And then when you look at the solution or the outcome, is it this trade with this mentality, how many times you have actually succeeded? Okay, the chances, what are the chances of winning if you have this kind of mentality? Or another mentality is that, oh, you always feel scared and then fearful, and then not knowing whether it is right or wrong, and then you are always doubting, and then in a kind of a fearful kind of a state of mind. And then the outcome, what is the outcome? Is it a very terrible loss, or is it a gain, or what is it? So I always do this kind of psychology kind of I call it a training, because I want to know when I'm going into a trade, what state of mind I am at. Okay, and then and what is the outcome? Okay, you do that as a exercise. And of course, you must also have a strategy. Okay, so for traders, they have a set of strategies that they must feel comfortable with. If you are good in the market news, for example, the non-farm payroll, then go ahead in doing that. Okay, if let's say you are good in the trend line, then you just go according to the trend line, because you must develop, or you must have a kind of a strategy that works best for you. that suits your personality, because different traders will have a different personality. So this personality will have to go well with your strategy as well, okay, so that you can consistently be a winner in terms of trading. And if let's say you want to rely on a technical indicator, like I show you, you must have a prerequisite first. That means you must be clear of what kind of sentiments you want to know first. Then you will choose the kind of indicator that suits this kind of sentiment, okay? Then it will tell you the answer, okay? So very often you need to be objective. Even though the indicator is telling you this, you must always be able to question yourself. Is it true? What if it doesn't happen? Okay, what will happen? Okay, and then how can we adopt good trading habits? So, and then you need to also develop the kind of a discipline, because as a trader, be disciplined is very important. Of course, you may not want to see losses, but however, you have to accept it as a trader. Taking losses or small losses is a regular thing. Okay, it's a normal thing. Okay, so if you do not like to see losses, maybe you can apply another strategy. For me, I really do not like to see losses. So the strategy that I apply is really kind of like a swing trading. Okay, swing trading. That means I will look at it as a bottom or a reversal. I usually trade at the reversal, bottom, or at the top. Okay, so when you trade at the bottom reversal, right, it is a swing trading. The bull, I mean the chances of gaining bigger profit is higher. Okay, and I usually choose the timing. So therefore I reduce the chances or I reduce the number of or the frequency of trading, but however I increase the chances of winning. Maybe my frequency of trading is very low, however the chances of probability of winning is very high. So that's my strategy. Okay, so I hope today you have enjoyed the lesson today, because this one is a very special topic. It's about psychology of trading, and in fact not many people actually talk about the psychology of trading. Okay, so back to you, Smita.
Okay, thank you, Pauline. I will just take back the control.
Okay.
Sorry, just 1 minute. Okay, can you see my screen, Pauline?
Yes.
Okay, so now we have a few questions. If you have any questions, you can just place it in the question box, and then Pauline will answer the question. So for the first question, can I just rely on one indicator to trade futures?
Okay. Okay, usually I would prefer, if you rely on that indicator, right, you need to do some back testing. Okay, so you need to use that indicator and to back test for a period of maybe 40 years of data, or at least 10 years of data, so that you see whether this particular indicator is working for that particular, because for my experience is that different indicator may suit different types of equities or the stocks. So your particular indicator, you must be able to back test and then be able to work well, and then you have to try out, see whether it works well or not. Otherwise, usually I will look at the indicator as a secondary. Okay, I will look at the trend line first, and then the overall price action, the trend line, and then only the indicator. Okay, I will not use purely, unless I use it as a investing, not a trading, like a long-term investing. Okay, long-term investing, I do use RSI, and I use a weekly RSI. So whenever the weekly RSI is below the 20 which is the bottom oversold position, then I will just buy some blue chip stocks to keep. Okay, so I will use that for my equity or long-term kind of investment for that particular indicator. Okay, so it depends on what is your need, and then you choose the kind of indicator to suit your need.
Okay. Thank you, Pauline.
Yeah, maybe you tell me what is your indicator that you use.
Well, this question is from Alvin. So Alvin, you can let Pauline know what indicator.
What kind of indicator you are using?
Okay, he hasn't replied yet. So I will just go for the next question first. Okay. So the next question is, if I buy stock based on technical analysis only, is it okay?
Stock, not futures, not trading. You mean investing stocks?
Yeah.
If it's the stocks, it depends whether short term or long term. If it's a short term, yes, because it's you don't look at the fundamental, you just purely look at the price action because it's short term trading. So like penny stock or whatever, you just want to get quick profit, and then you can rely on technical analysis alone. Okay, you don't have to look at the fundamental. However, if you are looking at the stock equity, but for a kind of a longer time period, then perhaps I think the best, right, you have to use is fundamental. So I think I mentioned before in my previous webinar whereby I said that it depends on whether you are into equity investing or futures trading, or it could be long-term investing or short-term trading. So these two, the approach is different. For long-term investing, I will have 80% of fundamental analysis and maybe 20% of technical, or sometimes I don't even look at the technical, I just purely look at the fundamental, okay, for long-term investing. But however, for short-term trading, right, I just purely look at the chart only. I don't look at the news or whatever. I don't look at the news at all. Just chart. Yeah.
Okay, thank you, Pauline. So for the next question, which time frame do you use in trading futures?
Oh, okay. I think I showed you guys before whereby I had the 5-minute, 15-minute, and a 30-minute chart. Okay, it's a. You can't see my screen, right? It's a 5 minutes.
I'll make you presenter first, then you can show your screen.
Okay.
Okay.
Okay. I do have a window of this. I save it in 4 charts. Okay, my 4 charts will be the time frame, lower time frame, which is in terms of 5 minutes, 15 minutes, and half an hour. And then this one is a daily chart. So I look at this 4 charts. I set it as a template, and then I will use this 5 minutes to look at the trend, draw trend line, and then the 15 minutes, draw trend line, and then the half an hour, draw trend line. Okay, so I look at this lower frequency kind of a chart. Okay, then of course the overview is the daily chart. You must have the overview first. Generally, you see what is the trend, and then you look at the. So over here, you see it's a kind of a bullish trend, and then here is a correction, and then now it's a bullish trend again. Okay, so it's a bullish trend for this particular futures contract. Yes.
Okay. Then the next question: which indicator can show a sideways market?
Okay. I would think that the stochastic, or even because usually for a sideways market, right, you cannot use the moving average. The moving average doesn't work well in a horizontal trend because it will be whipsaw. Okay, so therefore for a sideways market, usually will be this kind of indicator whereby it's either stochastic or RSI, whereby you have oscillator. Yeah, that's the keyword, oscillator. Okay, you look for oscillator indicator. Okay, so this oscillator indicator will give you the sideways kind of a trend. Yeah.
Okay.
But remember, don't use the moving average. Moving average doesn't work in the horizontal trend.
Oh, okay. Okay. So for the next question, for futures, how long is considered long term?
It depends on the person how you trade. For maybe for a day trader, from morning to the evening is a long term for him. But for me, long term is about maybe 1 week. For me, it's about 1 week. Okay, that's my long term.
Oh, okay.
Some people, they may have put it like a few weeks. It depends on how you trade. Okay, so it depends on your personality as well.
Okay. So for the next question is from Jeannie. So she's asking, hi, I would like to ask that how to make an effective daily trading plan. I'm used to long-term investing, not much experience in trading, but I would like to learn more practically.
Oh, you mean a trading plan for the futures, is it?
Yes.
Okay, so first you must have you must look okay, I will assume that she knows the technical analysis lah. So first you must look at the daily chart of the if you are trading at the FKLI, okay, you look at the daily chart of the KLCI index, okay, FKLI, and then you draw trend line first and identify this one. For example, this one that I'm showing you is the FCPO lah. So FCPO, the trend line is a bullish trend over here. Overall, over here is downtrend, okay, but this downtrend is broken and then now is on the uptrend. So I would identify the trend first, okay, so that's number one. Then number two, but before that I identify which contract I want to choose first, which market I want to trade first. Is it the FKLI or the FCPO? I identify first, okay. So if you are familiar with the KLCI index, you start with the KLCI, FKLI. However, if you are more towards a FCPO, then you can do the FCPO. But let's say you do the FKLI, okay? So you choose the KLCI index and then identify the trend. So if I were to look at the KLCI, I think now it's a bearish trend now. So bearish trend, and then you decide which month contract you want to trade. Is it the current or the forward? Usually for the FKLI, you trade the current month, okay, current month contract. Then you identify the support and resistance, okay, support and resistance. So for example, for a day, right, for 1 day, I start with the trading. I will have the support and resistance for that particular KLCI index already at the back of my mind. Okay, for example, currently our KLCI index is 1590 to the support, and then 1610 as the resistance. So I will look at this as my support and resistance, and then so that I have a rough idea where my price is going to move on that day, how it is going to move on that day. So that is my support and resistance level. And of course, this support and resistance, you have to refer back to your technical analysis, whereby it is the swing high, either it is a swing high or swing low, or you look at the volatility, okay, the volatility, that what was the volatility for the past few weeks, and then you project the next for this today. Okay, so and okay, once you establish a support and resistance, then only you enter, and then when you enter, you look at this 5 minutes chart and the 15 minutes chart and the 30 minutes chart. So you draw trend line. Okay, you start to draw trend line. So let's say I draw trend line, and then I say, okay, now I draw trend line, and then when the price break below my trend line, I'm going to short. Okay, so then you will have to short. Okay, so or you draw this one, then so you when you short, then you have to see, okay, what is my cut loss point? You must always have a cut loss point. So you have to write down your cut loss point. Then your cut loss point, maybe you have to refer back to your previous candlestick. or your previous the bar, the trading bar, okay, whether how big is the price action. Then you have to refer back to the swing low or swing high, or refer back to the moving average, the resistance line or whatever. So that is your cut loss point. Okay, you must always establish that. Okay, you must have a target and then your cut loss. So, and then this target and cut loss, it could be 1-to-1 or 2-to-1, depends on your strategy. So once you establish that, then only you enter into the trade. And then when you enter, then you wait for the thing to close. After you close, then you have to write down your trading plan. So basically your trading plan, right, you must have the type of the contract that you are trading, which month, and then the entry price, the target profit, and the stop loss price, and then the closing price, and then you calculate the P&L at the side there. Okay, so this is a typical of my trading plan. Okay, with all this information. Yeah.
Oh, okay, thank you, Pauline. Then for our next question, how do we know what type of indicators that is suitable at any point of time?
So that is why you want to ask yourself what sentiments you are looking at. If you are looking at the overbought and oversold kind of a sentiment, whether it is too bearish or too bullish, and then you want to take the advantage of people's bearishness. Okay, when people are oversold, you want to go in. When people are oversold, you look at the stochastic and the RSI. Okay, so if let's say you just want to look at the general bullish or the bearish trend, you can look at the MACD line. Okay, so it depends on what you want. Yeah.
Okay, thank you, Pauline. Then for our next question, do you think the inverted yield curve will be an indicator of recession and will impact our Malaysia market?
Okay. Actually, this inverted yield curve thing, I don't really believe so much about this inverted yield curve. What I believe is that what is happening, especially during the trade war, that one is a major concern. And then another thing will be whether our Malaysia economy, we are able to fight with the regional countries in terms of producing manufacturing, because looks like foreign investors are coming to Indonesia or our regional country, and then they do not come as much into our Malaysia. So how we going to the productivity and maybe basically is our structure, the structure of the cost structure or the productivity of the labor will play a part. So all this is more important than the inverted yield curve, because inverted yield curve is actually, even if they were to have according to the statistics, it's about 22 months. Okay, it's still like a long way to go. But then currently we are facing kind of economic slowdown in Malaysia. So what is the reason? We need to find the root cause. Yeah.
Okay, thank you, Pauline. Then for our next question, if the volume is very high for the day and the price indicator is red, what does it mean?
Can you repeat the question?
If the volume is very high for the day and the price indicator is red, what does it mean?
Oh, that means a lot of people are selling. A lot of people are selling. That means yeah, that means the price, the candlestick is the red one, right? So that means it's a drop, the price fall. So a lot of people are selling and then the price is dropping. So it is negative for that particular stock.
Oh, okay. Thank
because
you.
The volume bar also got color. So the volume bar also got color. So the green color is the buy volume, and then the red color is the sell volume dominating. So that tells you the difference.
Oh, okay. Thank you, Pauline. Then for our next question, for long-term investing, you said you use weekly RSI. Do you set the parameters as 20, 50, 200?
20, 50, What do you mean 20, 50, 200? 200?
Yeah, it's from David Young. This question is from David Young.
Again, okay, I have to listen carefully. Again.
Okay. For long-term investing, you said you use weekly RSI. Do you set the parameters as 20, 50, 200?
200. Oh, I think what he mean is that the 200 is for the moving average, is it? The moving average line, the 200 moving average. Because the RSI, the maximum is 100. There's no 200. So I will set 20 and 80. Okay, 20 and 80 for the RSI weekly. Yeah.
Oh, okay.
Then but this will be very difficult to hit lah. So it's very difficult to hit the 20. It's very difficult because it's a weekly and then it's a 20. So unless it's very bearish, then it will hit. Yeah.
Okay. Okay. Thank you, Pauline. The next question. What happens when AI dominated the trading scene? Will the market become efficient?
Yeah, I think it's very efficient. It'll be very efficient, and then ordinary people like us, we won't be able to fight the robots because they are too fast. So in the end, everybody is adopting a robot. Everybody must have maybe to be able to code, to do coding, and then to have their own robots, and then to do the trading for them. Like everybody must have a pet robot and then to do the trading for them. So that's the world that I'm seeing now, but I don't know. But I don't know how many years from now. But it looks like this thing is happening. Could be happening soon.
Okay. Okay. So for the next question, from Johnny Law, may I know the reason behind comparing the chart in 5 minutes, 15 minutes, or 30 minutes?
Okay, because usually the 5 minutes will give you the fastest sentiment. However, this fastest sentiment, right, may not be persistent, okay, may not sustainable. So then you have to look at the 15 minutes. So if 5 minutes and 15 minutes give you the same kind of trend that you are looking at, that means they reconfirm each other lah. Then you look at the 30 minutes, okay? So usually I will look at this 5 minutes as like a signal that tells me that, okay, it's going to change the trend. The trend is going to reverse, or the trend is going to change. Okay, so this lower time frame chart tells me what is going to happen, but may not be sustainable. Okay, I have the reservation. It may not be sustainable. I still need to look at the 15 minutes and 30 minutes to reconfirm. Okay, however, it depends on what kind of strategy. If let's say you are looking at a short-term kind of strategy, you just want to go in and then go out very quickly, maybe you just look at the lower time frame and then focus. The higher time frame is for you to reconfirm, okay, but then you must have your cut loss lah. That means you must really be disciplined to cut loss, because you should cut loss very often. And then you may in the end not making much money because of the frequency in trading, and the volatility is so little, and then you just purely doing the cut loss for nothing. Yeah. Okay. Unless the chart is a very volatile market. Okay, unless it's a very volatile market. If it's a low volatile market and then you do a low time frame, that means a low volatile market, you do like a 5 minute, 15 minutes, it doesn't work. Okay, it has to be a very volatile market, and then you do this 5 minutes, 15 minutes. So you must be able to choose the right market, maybe a forex or something. Okay, but however, for FCBO, there are certain times where it is very high volatility. So that is why I said I choose the time, the day for me to trade with high volatility days. Yeah.
Okay, thank you, Pauline. So now we are on to our last question. If the price indicator is a plus candlestick indicator, what does it mean?
Sorry, again?
if the price indicator is a plus candlestick indicator, what does it mean?
Oh, you mean a positive candlestick, is it?
Yeah, positive candlestick.
You mean a candlestick is a positive, like a green bar, like this one, a green bar? Is it like a green bar? It means that the price has gone up. Okay, the price has gone up.
Okay.
So is that what the question was?
Yes, yes.
A positive candlestick, right?
Mm-hmm.
Positive candlestick meaning that it is a green bar. That means the price, the opening price and the closing price higher. That means that it's up. For example, this one is a 15 minutes. That means beginning of the 15 minutes and end of the 15 minutes. At the end of the 15 minutes, the price action is like this. Then another 15 minutes. At the end of the 15 minutes, the price action is like this. And then when it comes to the doji sign here, it means beginning of the 15 minutes open here, and then end of the 15 minutes, it closed at the same place, whereby you back to the square one. Whereby you have the red color one, it means it's a down. That means beginning of the 15 minutes, and then at the end of 15 minutes, it's a down. The price has gone down. Okay, so over here you can see that the down, right, the red bar is smaller, but the green bar is bigger. So over here you can see that this market is quite bullish market, because the green bar, at one glance you look at it, the green color is more than the red color, and then even when you have the red color, it is kind of flat. Okay, low volatility. So that means this kind of price action is quite a bullish price action. Over here you can see a confirmation here as well, bullish price action.
Oh, okay.
Yeah.
Okay. Thank you, Pauline. So that was all the questions that we have.
Yeah.
And I'll take back the presenter control from you. Okay, so we have come to the end of this week's webinar, and our next futures webinar is on the 12th of September. Will be a Chinese futures webinar. So to register for the webinar, you can actually go to the link in the chat box. So the link is already dropped in the chat box, and you can register for the upcoming futures webinar on the 12th of September. The time is still the same at 8:30 to 10 p.m. So thank you again very much, Pauline, for another insightful session today. And
thank you for
thank you everyone for tuning in tonight. So have a pleasant rest of the day. Thank you again. Bye-bye. Bye, Pauline.
Okay, bye-bye. Okay, bye-bye.